Hi, welcome to FinTrail FinCrime Spotlight, a mini digest which covers current and topical issues related to financial crime. I'm Ciara and I'm joined today with Jess and Eoin Collins. So the Central Bank of Ireland issued a Dear CEO letter to payment and e-money firms on Friday the 20th of January. The letter covers many areas such as governance, risk management, culture, outsourcing, AML, you name it, it's in there. It addresses many of the common themes we've seen from the FCA recently and from recent enforcement actions as well. Firms, even if they're not based in Ireland, should be taking note because there's some useful things to be looking at. So, Eoin, like the letter highlights that the intensity of the Central Bank of Ireland supervision has ramped up for the sector over 2021, and we expect to see more in 2023. But it did also highlight there were significant deficiencies identified in the governance, risk management, and control frameworks for some of the payment and e-money firms that they'd seen. Can you give us maybe a brief overview of some of the AML issues called out in the letter?
Yeah, sure. I think one of the bigger ones was regarding the risk-based approach. That the CBI highlighted that some of these firms are just the manner in which they were applying it kind of lack maturity. So there were some kind of shortcomings in terms of understanding the risks that the firm faces, and then that has this knock-on effect of meaning that controls are insufficient, and then they're not also commensurate to the risk that they're exposed to, particularly looking around transaction monitoring, misconfigurations leading to either not enough alerts or too many alerts being generated, and also just a theme I think that we're seeing, from last year coming into this year is around the idea of effectiveness as well. That they may be applying a risk-based approach, but is it really that effective for some firms? So that was one of the big ones. And the other two regarding distribution channels, we're seeing that distributors and agents being used much more every year by firms in the sector, and that CBI noted that some firms, while they understood that these firms were doing work for them, they didn't really grasp the fact that they're an extension of the firm. So there needs to be more oversight. Insufficient oversight and assurance was really noted in this area. And I think the last bit was around simplified due diligence. I think this is something, it's not new, it's been a bit of a hot topic for a few years now, but again, misapplication of the CDD derogation in the Criminal Justice Act, and just not really paying enough close attention to the idea of the cards being unreloadable, can't be used outside the state, €150 limit, things like that. So three things really: risk-based approach, SDD, and the distributor route as well.
Brilliant, and I think we'll cover maybe some of those a little bit more in detail as we sort of talk through this. So Jess, a few weeks ago we covered the Coinbase consent order, and we're seeing some similar themes raised in the letter as we did on that. Particularly, I think they said that they seeing examples of firm strategic ambitions outpacing their frameworks and capacity. And like we've talked about growth and scaling a FinCrime function. What type of advice would you give to a growing firm in managing this?
Yeah, sure. I mean, it definitely, if we look back at the Coinbase consent order, maybe a shout out to our first episode of the Spotlight Mini.
Yeah.
We talked about lots of different things that went wrong with Coinbase there. So they weren't able to scale as quickly as they needed to, and the controls didn't keep up with that kind of scaling. So the governance and oversight didn't keep up. Team sizes were not appropriate. Tooling was not sophisticated enough and was not good enough for their size. And actually, we saw this as well in the Santander fine as well last year, that their model wasn't mature enough as well. So it's a really, really common theme that we're seeing a lot. And in terms of advice that we could maybe give, it comes back to some of the things that Eoin was just saying around the risk-based approach and proportionality. So when building control frameworks, I would always advise clients that you need to obviously understand your risks and then build commensurate controls in line with those risks. So it really comes down to understanding what those risks are and building your risk-based approach around that. Obviously, as you scale, your risks will change. So you might have more customers, different types of customers. You might be launching a new product type, and your control framework needs to change and mature in tandem with those changing risks. So you need to make sure that your controls are sufficient for those risks. And some of the ways to do that is just to make sure that you have good management information, governance, understanding at the senior management level of what your risks are and what they do as they change, so that your sort of senior management team are all behind you when you say, I need to adopt, I need to have a bigger team, or I need a new tool or anything like that. So it's all about proportionality, taking that risk-based approach and getting buy-in from your senior manager and having good management information flowing up to them.
Great, thanks, Jess. Like sticking with familiar themes that we've seen in the past, some of the things they called out in the letter, the CBI called out, was regulatory obligations being viewed as a tick box manner, not being adopted as a strategic enabler, and really a focus of regulation seen as a cost rather than a business enabler, and how that can deliver better outcomes for consumers and firms. So I think this is something we talk about a lot, how and bringing the word compliance and enabler together for the business. But Eoin, like, what are your thoughts on how compliance can be seen as a competitive advantage?
Sure. Well, I mean, I think the first thing, like you said, Ciara, we've been talking about this a lot recently, and I think this is something just for firms to pay attention to, because it's going to, you're seeing regulators moving in this way, not just in Ireland, where this check the box kind of manner is just not really going to cut it anymore. They're really starting to enforce this a lot more. So I think that's a competitive advantage in itself, just by paying attention and taking that on board. But I think secondly, with, to kind of piggyback off what Jess said, when people think about a really robust compliance program, sometimes it can be seen as scary, as a thing that's going to impact loads of customers. It's going to be lots of outreach, friction, etc. But if you're doing it in the way that the CBI are calling out here, which is you just are getting a deeper understanding of your risk, and then you're applying the commensurate level of controls to that risk, you're actually not going to impact the people that you don't need to. So I think that it's kind of got a double-sided advantage, where you're going to be keeping the regulator happy, obviously, because they see that you understand what you're doing. And secondly, you're not going to have that friction with customers that you may actually end up having if you have to do a big transformation project or remediation down the line, which would be much more impactful on your bottom line. So, yeah.
I think lots of things to be considering then, how you can use it going forward rather than sort of looking back too. So Jess, the letter itself had a very clear call to action about safeguarding, but I think within it, it also set out a very clear expectation on firms to take a proactive approach on governance and control framework. So like, what, in your mind, should firms be doing as a result of this letter?
Yeah, it was pretty brutal on safeguarding. I mean, I'm not going to cover safeguarding too much, but firms need to go out and get an independent audit on safeguarding quickly and respond within, I think, the 31st of July deadline to the CBI. That was pretty brutal. Definitely go and do that. But more on the financial crime control side, there were lots of different control areas that they picked out that you will need to go back and make sure that you are looking at in a proactive manner. So some of the things that Eoin sort of picked out right at the start. So going back and revisiting your enterprise-wide risk assessment for financial crime to make sure that your risk-based approach is appropriate. That is something that everyone should go away and do off the back of this letter. So making sure you understand your specific risks. Then look at your controls, measure the effectiveness of your controls against those risks. Are any sort of risks then outside of risk appetite? So really looking at what those are and building a more mature risk-based approach on the back of that exercise. A second control area that's really picked out as particularly weak, transaction monitoring. So they call this out specifically, and we see a lot of transaction monitoring problems and a lot of transaction monitoring backlogs at the moment as well. So making sure that you have a look at your controls here. Do you have any backlogs? Maybe look at getting some independent assurance and testing on your transaction monitoring tool. Is it configured correctly? Are you actually capturing suspicious instances? So really looking at transaction monitoring in a bit more detail and make sure that it's effective there. There's a number of different things that they pull out as well around CDD, and Eoin mentioned at the start some of the CDD derogations around 33A and section 34A. So making sure that they are all applied absolutely correctly. And then on top of all of this, which is a lot in itself, going back and having a look at your whole risk management framework. So what is your framework? What is your governance model? As I said at the start, have you got enough management information to capture how your framework is operating? Is it effective? Is it covering all your risks? Does your board understand your risks? Are all of these risks discussed at the right forum? So, I mean, there's so much to maybe go through here, and I maybe appreciate Eoin's view as well on some of these things.
Absolutely, and like I think that last point you made, Jess, regarding inadequate reporting, that was specifically called out. Is inadequate reporting to the board, particularly in relation to customer complaints, fraud levels, and that basically can inhibit the effective oversight of operations from the board. And I think this is something maybe less mature firms we kind of tend to struggle with, that whole how do you even do board reporting? How, it's obviously something we've helped firms with in the past, and it's really, really important so that the board is seen as a forum for help. It's not just this scary thing you need to report to. It's actually a board that will help you deal with those frontline incidents, I should say. And coming back to my previous point about it being a competitive advantage, this is all ties in with this as well, because if your board is seeing that fraud is through the roof, or that there's poor onboarding experience, these kind of things, they will want to get that fixed as well, because that will impact everything across the business. So I think reporting to the board is going to be a key one as well.
Yeah, and I think the value of things like your MLRO report that you do on the annualized basis, how much they are a tool for you to be able to reinforce what you need from the board resources, sort of budget, etc., to be able to drive forward some of the fixing some of the gaps, but also bringing through some of the enhancements as well. And I think actually, shout out for FinTrail, you'll be able to see some good, hopefully a helpful resource coming out on MLRO report frameworks over the next week. So do look out for that. So Jess, Eoin touched on it earlier, but a good point to discuss is around the oversight of agents and distributors. And we work with a number of BaaS providers with a focus on assurance for their distributor and agent network. What's important for firms to consider here?
Yeah, this is a really interesting one, specifically for us, because we do work with a lot of those banking as a service providers, as well as actually a lot of agents and distributors themselves. So we work with a lot of firms across this whole infrastructure. And it is specifically called out as another area of weakness here. And as Eoin said, the key issue is that BaaS providers are looking at agents and distributors as customers and not an extension of their control framework. But what they really need to remember here is that those BaaS providers own the risk, and they are, some of the controls are conducted by the agent and the distributor, but they need to have full oversight of those controls to make sure they are being conducted in a way that is in alignment with the firm's risk assessments, policies and procedures, everything that they would expect and they would do themselves. That should be what the agent and distributor is doing. At the moment, that oversight is just simply not strong enough. And we've worked with many different firms to try and support that assurance process. But ultimately, it just needs to be looked at in more detail. And it's really interesting to see it called out specifically here.
Great. Brilliant. Well, thank you both for that. That we unpacked quite a bit in the session. So really helpful overview. Eoin, Jess, thanks again. And to everyone watching FinTrail FinCrime Spotlight. Cheers. Bye.